I think silver is very underpriced. If you just look at the 10-year chart in gold and silver, and you're talking about $19,000 gold, arguably silver should be well over 25. And so the big question from a more medium-term perspective is why is silver so cheap?
Welcome back to Soar Financially, everybody. I'm your host, Kai Hoffman, the CEO of the Soar Financially Group and the @JR Mining guy on Twitter. Thank you so much for joining us because we have a special discussion lined up today. We're going to talk about 3 scenarios that are likely or unlikely for gold and the gold price futures. Lots happening in the world on the macro scale, and we've invited MKS PAMP. I have to look up the name. It's like I'm struggling with it a little bit. But Nicky Shiels is joining us. She's the head of metal strategy over there, and somebody I found on CNBC. Actually, I was program hopping. I was like, whoa, they're talking about gold, and just like excellent insights. And I connected with her about 6 months ago on Twitter already, and I think I reached out to her on LinkedIn as well. So I'm really happy that she's joining us today because she also won the LBMA Gold Forecast Award last year. She came in within 9 cents with her forecast, so she forecasted 1,800, and the market closed at 1,809 cents. So congratulations on that, Nikki, and thank you so much for joining us here on the program.
Yeah, great to be here, Kai. Thank you.
Yeah, absolutely. I apologize. I struggled a bit with the company name you work for. Maybe as a way of introduction, why didn't you quickly tell us what MKS PAMP does? Because it's not a known quantity, at least here in Germany.
Yeah, for sure. So MKS PAMP is a global physical refinery and trade house based out of Switzerland. So we have a refinery, precious metals refinery in Ticino, Switzerland. Our headquarters are in Geneva. And then we also have a pretty large presence, another operation in India. So think of us as one of the largest big 4 Swiss refineries that source gold globally, and sort of a big part of the global gold supply chain.
Fantastic. Yeah, we'll get to a line of questioning there. I hope we have some time for it as well to discuss sort of the west to east movement of gold and how the Swiss refineries play a role in that. I hope we get to that because I think that's really, really interesting. But let's dive in and start with the macro, because here on Soar Financially, we try to look at the macro to understand the micro. And for me, the micro is gold, and then, of course, the miners later on as well. But let's talk macro, Nikki. Like, what's your current assessment of the global economy and the U.S. in particular, probably?
Yeah, I mean, I think it's the macro backdrop as it currently stands, I think is very different to where we were, let's say, in March Madness, is what I like to call it, during the peak of the banking crisis, where there was just an overreach for safe haven, such as gold and bonds. We've really dialed that back. We saw sort of one-half performances, huge outperformance in tech, huge outperformance in US equities, and really just no macro fear, as I like to call it, sort of came through in Q2. So you've seen some of that fear buying being erased in gold, but simultaneously at the same time, we got 10-year yields sitting at 4%, and real yields pretty much at year-to-date highs, and gold is still kind of holding in at 1,900. So it's given the lack of geopolitical headlines, the lack of macro fear, the lack of sort of banking crisis headlines that we've been through, I think price action in precious metals has held up pretty well, given that sort of reversal what we've seen since March this year.
Markets and gold in particular are a bit, I wouldn't say puzzling, but I find it interesting, like why gold is holding up so well. I think this is one of the key questions I have lately, because you mentioned it before we hit record here, that the ETFs are seeing outflows, actually, the physical ETFs, but the central banks are buying. That's at least what we're being told, depending on reports. Is that what you're seeing as well? Is that something you'd underwrite?
No, I think it's one of the most critical sort of core underpinnings of why gold and silver, to that matter, has held up relatively well the past 2 years, and why sort of those like fundamental traders coming back, where we're seeing on the silver side, we're seeing it's more being played out in sort of retail, a lot more resilient pricing. And then gold's got both of that. It's got the coin and retail demand, but it's also got central banks, which are proving to be a lot more resilient even at higher pricing. And so, yeah, that kind of plays into this theme that, yes, despite the fact that we've seen 15 days or something of ETF outflows, which, is a bit of a drag on sentiment, at the end of the day, those outflows are finding their way, it's kind of that west to east theme where Western ETFs are deleveraging because of the lack of macro fear, or because of the fear that perhaps the Fed will have to be higher for longer. And that those outflows are indirectly or technically finding their way into central bank hands, which predominantly are emerging markets, right?
Well, east to west movement, central banks. I think there was an interesting article that came out yesterday. It was the Invesco survey, where it says, well, everybody's repatriating their gold. Can you break that down for us? Like, who is everybody and who is repatriating? I know Germany tried to repatriate some of its gold holdings from New York back to Frankfurt. We still haven't gotten everything, by the way. I think we're still waiting on some of it. But what was the essence of what'd you get out of that? I know you've been following that as well.
Yeah, so the way I look at it, generally the trend among central banks has been, they've been very steady buyers, especially on dips of gold, and it's especially been your emerging market central banks, which that pace of gold buying or de-dollarization policies has just been accelerated since the war in Ukraine. And given this fear of a sanction risk, or this confiscation fear, a lot of sort of typically emerging market, I'd say non-developed central banks are looking to repatriate gold home. Generally, a lot of central banks do hold gold at the BOE in London, and those holdings are actually public. And over the past year, you've seen the amount of gold held at the BOE steadily declining, as countries are looking to take gold back home. And it's basically this, it's as safe as where you can see it. And again, I think it's indicative of the lack of trust in the system. I think it's before gold was perhaps playing more of a interest rate or FX hedge. I think it's now sort of rotating into more of a safe haven asset class for these participants, and I think that's indicative by this repatriation that's ongoing.
What about timing on that matter? Because last week as well, we've been hearing quite a bit of news of a new currency coming out by the BRICS that is supposedly gold-backed or partially gold-backed. So I find the timing of that Invesco survey quite coincidental to the whole news there. Like, can you make rhyme of that for us? Does that make sense for you? Do the dots connect there?
Yeah, to a degree. I think it's this de-dollarization theme. It's massive, and it's structural, and it's not going to be linear. And I think absolutely countries are going to look to downsize the exposure they have to the US dollar. But in terms of just the amount of flows, it's not going to happen overnight. It will be incremental, but it does support the sort of recommoditization, sort of the pro-gold policies that we're seeing among central banks. The talk around a new BRICS alternative currency does really support the deglobalization, the de-dollarization structural theme that is ongoing. But again, I think it's still very early in the days, and it's at the end of the day, the largest gold holders is the Fed, followed by quite a few European and developed market central banks. So the splintering of the gold market, where the Eastern central banks are going to accumulate gold and up their sort of gold exposure at the expense of the US dollar, just does bring gold into the conversation more. And I think in the medium to long term, it's structurally bullish. It's just very tough to forget the short-term implications at the moment.
Absolutely. No, I agree with you there, Nikki. I've been asking, I had guests like Alistair McLeod on or Egon von Krajec the other day, and I asked them,
Yeah.
like, is there a policy, like even unofficially, where the West is not allowed to buy any gold ounces or the Western central banks? Because it's all the Eastern central banks buying gold, except maybe Poland and I think Ireland sort of made an excuse there to buy some more gold, but none of the other Western nations sort of bought any. Is that are they afraid to undermine their own policies?
No, it's a very good question because just simply, about 10 years ago, we had policies in place where they were limiting the amount of selling, right? So most of your central bank gold agreements, CBGA 1, 2, 3, and I even think we went up to 4, dictated how much central bank selling from your typical Western central banks were allowed per year, and there were quotas on that, and that the fact that central bank policy also doesn't change. We sometimes we forget we put our trader hat on and we realize how fast the news cycle is. Whereas there's a much longer sort of time lag and these in decision makings from the central bank. So I think the fact that they were net sellers for the past 2 decades in the 90s and 2000s and haven't been net sellers over the past 10 years, that in of itself is pretty indicative that I would say it's rather supportive of gold. Why they haven't turned net buys? I mean, a lot of the gold holdings within these developed market central banks are already sitting at 60-70% of FX holdings, so they're pretty overweight as is. So merely holding on, I think, is certainly a sign of support for the asset class from those developed market central banks.
Yeah, interesting. I appreciate you clarifying that and sharing that information with us. In the intro, I mentioned we're going to look at some macroeconomic scenarios that are affecting gold, and one of them is restrictive policy. The other one is sort of a mild construction. I call it the status quo, and the other one is a credit crunch, right? Um,
Okay.
where are you leaning? Like when you look at the policies, and it's mostly Fed dictated policies. If you look at it, because it all has to do with the interest rates, because I think they have the biggest impact on gold right now, as it is a
Right.
very sensitive commodity and a very sensitive asset to the Fed policies. If you had to choose one of the three scenarios, which one would you lean and why?
Are we? I mean, we are predominantly in the sort of milder contraction camp. Everyone expects a recession almost by Q3 this year, in the beginning of this year, and we just kind of keep rolling out those recession estimates and forecasts. So yes, I think the labor market is certainly proved to be a lot more resilient than many expected. There is certainly a thinking around the fact that there's simply a lot more money and liquidity in the system, which actually could argue for a much more restrictive Fed, right? So that's the other scenario, in which case the Fed will have to be go higher for longer, and we're talking about 6% plus terminal rates. But we're in the camp that something will break. We will, and it's likely going to come through in the labor figures probably the second half of this year. But the fact that we're going to see a mild contraction in the US, and that would be mildly supportive of gold. Yes, we still bullish. I think your other scenarios, a credit crunch, is extremely deflationary. I think that's deflationary for pretty much every asset class. But it will portend to sort of bigger cuts and a bigger Fed response down the line. And then a super restrictive policy is also outlines a pretty bearish outlook for gold, just given that the higher rates for longer, and it's the uncertainty of when the Fed is going to pause that gold and silver pretty much struggle with. And ultimately, it could be a large macro headwind. And we spoke about the fundamentals, but the fundamentals are still coming through at these higher pricing. So it'll basically ensure that these metals are trading at or near where their fundamental physical floors are.
Interesting. Like, what do your models predict, sort of, for what the Fed might do until the end of the year? Two more rate hikes. Do you agree? Do you not agree? Like, what do your models suggest?
I think let's talk about what gold thinks. So I think gold is pricing close to 2 rate hikes. I mean, just given the way price action has traded, is we're full over $100 lower. We're looking at fundamental floors below 1900, where we are seeing there are strategic and physical flows coming in below there. So the fact that it has responded pretty positively just to a mild miss in the NFP this Friday, I think is indicative. So I do think gold, like we said, it's hanging for something else. Otherwise, we would have been at 1800 by now, given the fact that the Fed is now overhanging 2 rate hikes of the market, and it isn't. So I think you do have to respect price action. And so I think gold and silver are pricing close to 2. I think if the narrative and the thinking and rate hike expectations push out to even further, and come Q3, we're talking a further a further 2 rate hikes even after the July hike, then I think then we're talking another $50 or $100 repricing low, and we'll try to probe lower floors. But for now, it's pretty content around, let's say, 1900 on the short term, perhaps like a $50 pullback. But I think that's certainly an opportunity to get involved.
You just updated your mid-year forecast as well, so I'm curious what the dollar numbers are until like the end of the year for, let's say, for the next 6 months. I'm just curious, what did you put in there?
Yeah, so our forecasts for 2023 are 1930 for gold and 24 for silver. Both of them are unchanged. We revised up our forecast in March following the banking crisis, and I'll be honest, probably up until June, up until when the Bank of Canada and the RBA really changed the rules of the game, when they collectively turned hawkish that first week in June, is when everything turned over. But up until then, we were looking to actually upgrade our forecasts, and probably a $50 upgrade, in silver, probably a $1 upgrade. But again, the month of June really changed the thinking, the macro landscape, where now we're just thinking higher for longer, right? And it's been solidified with either surprise hikes from other central banks or the rhetoric. And so we've kept our forecasts unchanged. I do think, though, I have still kept the fact that we're $170 off from all-time highs, and that's a very known triple top up at around 2070. And so when and if we do see the softness come through in the labor market, and you do get that confirmation of a Fed pause, and a US dollar weakness and some sort of convincing rollover in the US dollar, that becomes a very positive feedback loop for gold. And I think that's where you get investors very much engaged, and that's the next $100 leg up. But for now, investors are pretty much sidelined, like we spoke about. I mean, ETFs are net sellers. Generalists are involved in other asset classes. It's tech and AI for the moment. So I think that there just needs to, there needs to be a pressure specific or a US dollar specific catalyst to re-engage sort of the momentum and the investor more fresh investors in the space in order for us to probe all-time highs again.
Yeah, I kept saying in the past that we need to secure the 401k money, but they're chasing AI dreams right now. So,
right.
right. I have to ask though, like, how do you rate silver versus gold? Because gold, you're pretty much spot on right now at 1930 with your forecast, but silver, you're still $1 off. Like, where is that divergence? Like, I'm just curious because you've just updated your price forecast, I think, within the last 10 days here. So.
Right. We sometimes get stuck in looking at sort of year-to-date charts, and I'm also guilty of doing that. I think silver is very underpriced. If you just look at a 10-year chart in gold and silver, and you're talking about $2,000 gold, arguably silver should be well over 25. And so the big question from a more medium-term perspective is why is silver so cheap, right? And you can look at the gold-silver ratio, or simply looking at sort of long-term price trends given where gold is. So I think there's a few explanations of why silver is not has battled to sustainably remain above $25. One is obviously recession fear. So a lot of your industrial like metals, whether it's PGMs, your sort of base metals or silver, have really struggled to hold on to gains. And then two, I think there's simply a lot of sort of primary supply related or producer related selling, given the fact that base metal production and silver is a byproduct base metal production has really been built out, and the expansion on that side. But $24 is arguably fair. Silver can and has proven to move. It can swing easy 30-50 cents in a day up to $1 easily. So I still think there's a larger upside risk to silver than there is to gold, especially if we see a convincing rollover or weakness in the US dollar. Silver really is that high beta precious metal. And one of the analysis we looked at was the performance of most commodities, and including obviously precious metals, over past Fed pauses. And the overwhelming outcome was generally your high beta, very cyclical metals, whether that was palladium, nickel, or silver, were generally outperformers during times when the Fed paused. So we do see a lot of upside to silver.
Fantastic. Yeah, fantastic insights there. Appreciate that, Nikki. I do have to ask a question which half my viewers will hate me for. But it is like, do you see silver as a precious metal or industrial metal?
Oh, it's a precious metal with an industrial hat. It was, if we're going down that route, I would argue within the precious space, base metals within the precious space, palladium is probably as close to a base metal in terms of how you analyze it, in terms of, it is a lot more fundamental with very little investment demand. So that's probably your most base metal-esque precious metal is palladium, followed by platinum, then silver, and gold's obviously the least.
It's a question that always triggers responses.
Right.
So it's a good one. Nikki, I can't let you go without asking, like, how's the refining business doing? I'm really curious. You mentioned the transfer of gold and precious metals from west to east. Can you catch us up there? What does that look like right now? Where's the gold going in the east? Can you tell us there? Like, lift the curtain a little bit. We're really curious.
Yeah, absolutely. So we're plugged into plenty of your physical hubs globally, whether they're Southeast Asia, China, Turkey, which are very, India especially, the Middle East, and these are very gold centric or precious metal centric hubs where precious metals is not only an investment or a hedge against the fiat like system or a hedge against the sort of uncertainty around the politics, but it's almost a cultural affinity in some of these regions. So we're very much on the ground there and see, and that it comes back to my earlier comment where even given the past bullish cycles, bull cycles we've seen in gold and silver, and that was 2011 and again in 2020, we're seeing the fact that that physical demand from most of these regions is still really resilient, and more so versus previous bull cycles, which there's still an affinity despite the fact that local currencies have crumbled and your purchasing power has softened with that. There's a desire to accumulate gold, to hold gold, and you've seen that through regional premiums, which which we're active in. Premiums in Turkey, in the lead up to the election, was over $100. We're seeing premiums in the Middle East. Premiums in Thailand are pretty volatile, but India has also recently been in a premium. So what we do as a refinery is, we would like, with the eyes and ears of the physical gold market, obviously taking in gold, whether that is primary production from producers globally, or whether that is actual or bars or coin or scrap, and feeding that to centers of demand where we have good relationships with. So overall, I would probably deem, if I had to sort of quantify how strong physical demand is. I wouldn't say it's firing on all cylinders. We're not at $1,600 like we were last year, but I'll probably say we're firing on almost all cylinders in terms of strength and resilience to higher pricing.
Interesting. Yeah, no, I appreciate you sharing those insights. And I have one follow-up question. Like, what is the supply and demand right now? Like, is it pretty much even, or do we have a supply gap, demand gap? Where do you see a gap at all?
I tend to not. For silver, I certainly factor in the fundamentals and whether we're in a surplus or deficit, and we're going into the second year of a pretty decent size 250 million ounce deficit for silver. So again, it really underpins sort of a that bullish like undertone for me in silver. Gold, we get this question a lot, and I really battle to look at gold through an S&D fundamental lens, because the higher the prices go, most of gold sits above ground, not underground. So what is that? It's where the next marginal demand is stemming from. What is that going to do to pricing? Is that a $50, $100, $200 move? And then what subsequently what that pricing does to entice back scrap or jewelry or physical coin and bar sales. Primary supply is certainly less responsive within let's say $200 or $100 price swing. So I look at gold through, it's really more of a marginal demand asset class, whereas silver, I think it's certainly moving into a pretty pronounced deficits. And that should be underlying support of the silver for sure going forward into the medium long term.
Fantastic. Nikki, I appreciate you bringing silver into that question as well, because Silver Institute put a study out. I think it was 120 million ounces or so. I might be wrong, but right around there. So I'm curious, I appreciate you as a refiner confirming sort of that thesis as well. So, because we haven't had a refiner on, so it's good to hear it from that angle. Nikki, fantastic conversation. I tremendously appreciated it. Where can we find more of your work?
I'm on Twitter. Personally, we can also add anyone to our distribution list. Metals Daily tend to publish, and then also our website, MKS PAMP, and we have a markets webpage where we do publish a lot of sort of more the thematic and some of the outlook. But yes, we're out there.
Fantastic. We'll catch up with you before the end of the year, because we need to see how you're doing, how your forecast is playing out, because you updated your forecast during the banking crisis as well. So if there's another major event like that happening, we'll have to bring you back on. Really appreciate your time, Nikki. Thank you so much for joining us from New York. And to everybody else, thank you so much for tuning into Soar Financially. We hope you enjoyed this conversation with Nikki like I did. Really insightful. First time we had a refiner on the program as well, so really interesting insights from that angle as well. Nikki has been having a fantastic track record here forecasting gold and silver prices. So personally, I hope she's a little wrong with her gold forecast. I hope it goes a little higher by the year end. But hey, that's the hopeless optimist in me, right? But follow her on Twitter. We'll link to it as well down here in the description. And to make sure to follow us here on this channel. I know 80% of you watching are not subscribed. Let's change that. There's a button. It's called, it's called subscribe. It starts with the letter S. It's a square box. We really appreciate it. Hit that like button as well. Leave a comment. What do you think is going to happen? Is silver a precious metal or industrial metal? Let's trigger you guys. Leave that in the comments below. We want to hear from you. Thank you so much for tuning in. We'll be back with lots more.